Thank you for checking out Real Talk Personal Finance. Shit's about to get real. Cash Flow King with you today. And in today's episode, we have bonds. Before we get into today's show, as always, just a couple of quick announcements. First is this is the last week for those that are not currently premium. To become premium and be entered into our Q3 e-gift card giveaway, $25 e-gift card giveaway for Q3. We're going to ramp it up quite a bit like we did last year in Q4. We have our Q3 quarterly e-newsletter that Cube Crusher puts out for us. That'll be coming out in October. So anybody that becomes premium in the next week, you guys will be eligible for all that. You can read about the other benefits and promo codes for merch and stuff like that. Just click on the link in your show notes about becoming a premium subscriber today. And thank you, as always, to all of you that are premium, because you guys help to keep the show going. You help to keep the show ad-free, right? We don't have any ads on the show at this time, and we appreciate that. And hopefully, if you like what you hear, it's only $3 a month, so consider becoming premium. All right, so not a ton in the way of announcements today. We did get an email that came into the show. I'm going to read that to you. This subject line of this email is bonds. It says, "Hey, Cashflow King, I was wondering, did you ever do an episode on bonds? I was looking in the Real Talk Personal Finance channel and couldn't see anything. The reason I ask is I watched an Instagram reel from a guy named Life Goal Investments, and he talks about how the Fed cut rates, and now high-yield savings account rates are obviously going to go down, but he mentioned people are switching over to bonds. I'm not even sure how that would work or where you would buy a bond. Anyways, a show topic on this would be good information if you haven't done something like this already. Thanks." So, as always, we appreciate everybody's feedback. In today's episode, that's kind of what spurred today's episode. So the topic is going to be on bonds today. If you have any show ideas similar to this or something you want to hear about, you can email the show, realtalkpersonalfinance@gmail.com. You can also click the link in the show notes to text the show, and we will get that in our fan mail and respond to that in audio format on an upcoming episode. So what I've decided to do for today's show is this is going to be a very quick, and we could probably do a 6-hour podcast on bonds if we really wanted to drill down and get into it and go over every single type of bond and how each of them work and where you might buy them and their use cases and all that kind of stuff. Most people are probably not going to sit through that, and to be quite honest, I don't want to fucking do it. So we're not going to do that. Instead, what we're going to do is hit some highlights in a couple of key areas that I think most people are probably going to be most interested in if you have any interest in bonds at all, no pun intended, and then give you sort of a springboard to launch yourself off into and go do your own research on it. So you might hear some things on the show. If they strike a chord with you and you want to learn more about it, you should be able to go ahead and research some of the stuff if it's of interest. And if it's not of interest, no worries. You didn't listen to a show for 6 hours about bonds in excruciating detail. I will say I don't believe we've done a show on bonds. Quite frankly, I didn't look. We have over 100 episodes at this point, but I don't believe we have, and that's probably a little bit of bias coming through for myself and Cube Crusher because personally, we don't typically really at all use bonds in our own portfolios, specifically for retirement, but I can see why some people might. I certainly have clients that use them in different ways, and so we're going to talk through some of that stuff today, but I think that the main underlying theme, and this is a quote, I don't know who to give credit to because I think I read it in a book one time, somebody in the industry said something about bonds, that's where money goes to die. And if you think about it, you know, people use bonds for different reasons, but in the context specifically of a retirement plan, generally speaking, people are contributing to those for decades. People are trying to grow a portfolio over time, and people want that growth in order to achieve their financial goals and have positive and desirable retirement outcomes in the future. Now, does that mean that you need to have a 100% equities or stock-based portfolio? No, I happen to have one, but that's a whole separate story. But you know, not everyone's going to do that, right? So let's get into a little bit about why, what's the role of bonds and why do most people utilize bonds if they choose to utilize bonds? Well, actually, before I get into that, let me start with, essentially what a bond is, because that's one of the things, and we don't really, some of the stuff we do on the show is pretty elementary and basic in nature, but I don't think we've ever done an episode like this is a stock and this is a bond, and I guess we could do some of that shit, but we haven't. And so I don't know what everyone's understanding is about fixed income or bonds, but just to keep it, super high level and simple here. And by the way, when you hear fixed income or when you hear bonds, generally speaking, those things are interchangeable. So if somebody's talking about bonds in their portfolio or fixed income in their portfolio, pretty much the same thing. Okay. And what bonds are essentially debt instruments that will pay a regular interest payment, sometimes called a coupon. Okay. And then at the end, if somebody buys an individual bond, and we'll get into this versus bond funds here on today's episode, then the principal is returned when that bond matures, okay? And these bonds can be issued by governments, they can be issued by corporations, they can be issued by any other entity that's trying to raise capital. And there's different ways that happens. There's different types of bonds, different time frames, you name it, taxation implications, although a lot of them are the same. There are some that are a little bit different. We're not going to have time to get into all the little nuances of all of that today, but it's very different than, for example, stocks, which are essentially equity ownership pieces or pieces of ownership, equity ownership in a company, for example, a publicly traded company, right? So just throwing this out there, let's say you were to buy a bond, a corporate bond that was issued by the Coca-Cola company, right, for X number of dollars. Okay, well, they're going to have a stated rate or a coupon rate, an interest rate that they're going to pay you for lending them that money, essentially. You're going to collect that at a certain frequency, and then at the end of it, at the bond's maturity, you're going to get your money back. Right? Versus if you bought stock in the Coca-Cola company instead, now you have an equity or ownership interest in the company. And depending on how the company's performing, if it's doing well and that stock price goes up because that company becomes more valuable, then you have the ability for capital appreciation or growth in that particular instance. That stock may also pay a dividend, right? Think of that kind of sort of like a little piece of a kickback, if you will, or distribution from the company. And, there might be some funds in terms of profitability that are not reinvested into the company, instead are paid out to shareholders. That would be true in the way of a stock. And then there's a million different types of convertible bonds and all kinds of shit out there. We're not going to get into all that today. Point is, stocks, you're looking at equity ownership. Bonds, you're basically making a loan. And in return for that, you're going to get a coupon or an interest payment. And in an ideal world, if you buy an individual bond, you're going to get your money back at maturity. All right. Now, so what's the role of bonds? Why do people typically use bonds? Especially if you're looking at, portfolio design and construction. And the ultimate reason, for the most part, is they're wanting stability in their portfolio and they're wanting income production. So as I mentioned earlier about the stocks or equity component of a portfolio, if you are trying to design, your textbook moderate portfolio is generally roughly, and we're going to dive into this with a white paper a little bit later today and how that could be changing over time in the opinion of some, but you're typically looking at roughly 60% stocks or equities and 40% bonds or fixed income, right? That's your typical textbook moderate portfolio. You hear it often referred to as a 60-40 portfolio. Okay, fine. So why is it structured that way? Well, what exactly is going on there? And so you have the 60% in the stock or equity portion is designed essentially to be the growth engine of the portfolio. So when markets are doing well and the stock markets are doing well, that portfolio has the ability to go up in value. It has the ability to grow over time, and it's pretty volatile for the most part, right? And you can structure a 60-40 portfolio a million different ways. Depends on what your 60% is comprised of. But generally speaking, it's going to be fairly volatile. Then you have the 40% of the portfolio that's bonds or fixed income. And generally, it's designed to, you hear people talk about diversification all the time. It's to kind of ebb and flow, right? The bond portion, that 40%, is designed to provide some sort of stability so that, when stocks might go one way, bonds go in the opposite direction in some cases, although in 2008 we've seen that they actually all went down in tandem, so that's not always going to be the case. And then also for income production, right? You're having those interest payments or coupon payments that are kind of going back into the portfolio, and you just have a piece of it that's a little bit more stable. And I think the main reason, and most people may not admit this or see it this way, but a lot of times people say, well, what's the right portfolio for that person? And there's a whole host of things that you need to go through to figure out what that is. But I will tell you that I think one of the reasons that people will introduce fixed income or bonds into a portfolio, specifically in the context of retirement accounts, is to provide that stability and basically be able to hold on through the market ups and downs. Because if you have somebody that has a portfolio that's 100% equities or stocks, like I do, and I think Cube might too, or pretty close to it, there's going to be a lot more standard deviation or variability, right? A lot more ups and downs that happen with that. And most people don't have the fortitude to be able to hold on in those environments. And so what do? Most of the time they end up selling all their investments. They move to cash. They're basically fucked, right? The market drops out. They sell everything at the bottom, and then the market rebounds and they say, oh shit, I want to get back in. And they try to get back in and they end up paying more for everything and locking in those losses, right? So I think in a way, having bonds or fixed income in a portfolio can help a little bit with the stability of what that looks like. So that, for a lot of people, that's going to be the role of bonds, specifically in the context of like a retirement portfolio. People might also use them for different reasons. And so the email that came into the show, the listener that asked about bonds, and I don't know who the fuck the person is on, I think he said Instagram or something. I don't have Instagram. I don't have TikTok. I don't fuck with it. I got YouTube. That's all I need. And YouTube Premium, by the way, I pay for it, and it's excellent. You get YouTube Music, you get ad-free stuff on fucking YouTube itself. There's a lot of other things that go along with it. You know, kind of like our premium membership, only ours is way more affordable. Anyway, shameless plug. All right, so back to the show. So some people might look at this and say, okay, well, what about the relationship between bond prices and interest rates, right? There's an inverse relationship. So what does that mean? Well, generally speaking, when interest rates go up, the value of existing bonds and their prices go down, right? It's the opposite. So if we think about this, and I've actually seen this in client portfolios in recent times, where you have a client that's been in a portfolio for, let's say, a handful of years, okay? Markets, the stock market in general has done well. So those portions of their portfolio have gone up and risen in value, which is always nice. However, you'll notice that the fixed income component of their portfolio in a lot of cases has gone down. And that's very counterintuitive for a lot of people because they think about this and they're like, well, wait a minute. You hear that stocks are quote unquote risky, which is not necessarily true, and that bonds are quote unquote safe, which is also not necessarily true. And people say, well, why wouldn't I just put all my money in bonds? Well, this is a great example of why that could be, because as we've seen in the past couple of years, up until very, very recently, rates have been running up pretty sharply. So what does that mean? As rates have gone higher, the existing bonds in a lot of these bond funds, which we'll touch on here in a minute, become less valuable and they go down. So let's think about it this way. Let's do a little quick example, okay? Let's say that there's a bond out there that has a coupon or an interest payment of 3%, all right? So you're getting 3% to your face for this bond. And all of a sudden, rates go up. And now rates are 5%, let's just say. And there's bonds out there paying a 5% coupon or 5% interest rate. Well, who the fuck wants to buy your 3% bond? That's dog shit at that point, right? People are like, why would I buy a 3% bond when I can get a 5% bond? And then it's like, well, shit, I guess I have to sell it to you at a discount in order to make up that difference to even make you remotely interested in buying my bond. So now my 3% bond, the value of that goes down in the fucking toilet, because anybody can go out and just buy one for 5. So why would they want to buy yours for 3? So the value of that bond goes down. Okay. Now, we'll touch on this really quick because I've alluded to it a couple of times. You can buy individual bonds, and some people do. And there's pros and cons to doing that. Or specifically in the context of like a retirement portfolio, for example, a lot of people will actually buy bond funds for different reasons. Why would you do one versus the other? Let's touch on that real quick. So an individual bond, if you were to hold it until maturity, right? And if the issuer, whether that's a corporation or if it's a government bond, right? Whoever you're buying it from, as long as they're able to make good on it, you're going to get your money back at the end if you hold it until maturity, and you're going to get whatever coupon or interest payment was promised to you along the way. So as long as you hold it to maturity, then technically you can make an argument that, well, I'm not going to quote unquote lose money because I'm not going to sell my bond for a loss. I'm just going to hold on to it at the coupon that I essentially bought it for and then just get my money back at maturity. And you can make an argument about time value of money and is that the best use and could you have redeployed? And we're not going to get into any of that right now. But you could have an individual bond. A lot of people in these retirement accounts, though, will have bond funds. Why? Well, one reason is diversification, right? You could have a fixed income or bond fund that owns hundreds or potentially even thousands of individual bonds. So right then and there, you're going to take the same dollar, and put it into a bond fund as opposed to an individual bond, and you're going to pick up automatic diversification, and that's going to be spread across multiple different individual bonds. Now, so you have the diversification component, but the tricky part is bond funds don't necessarily have a definitive maturity date because remember, they are essentially baskets of these individual bonds, all of which are going to have their own individual maturities. And even though different types of bond funds could be targeting different windows or what we call duration, right? You could have a bond fund that targets shorter term duration, maybe just, a few years, for example, versus long durations, maybe 10 plus years, for example. And those are all going to react differently to changes in movements and interest rates and shit like that. But the point is they don't all have the exact same maturity date. And so when you invest into a bond fund, in the example I was just giving a moment ago, you have clients that are holding these bond funds. And as rates have sharply risen, the whole basket that, comprise that bond fund, all those individual bonds are now basically not worth as much. And therefore, the value of that bond fund that they're invested in is not worth as much. So what happens? You see some fucking red on your statement, right? And again, a lot of people, that's counterintuitive. They're like, wait a minute, I thought I was going into bonds because they're safe, okay? And you can make an argument about characteristics and that generally speaking, bonds will typically be more stable than stocks, but they also typically won't have as high a rate of total return as stocks and blah, 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 blah. But the point is they can, and as we've seen, they do still go down, okay? So, and that's why, because of that inverse relationship. So going back to the email that came in, and by the way, if you guys hear something in the background, we're getting some weather right now. It sounds like someone's fucking screaming. It's the wind, okay? So I'm not murdering somebody in the background here, all right? So going back to that email, you have these high yield savings accounts where they're basically driven by interest rates, and virtually all of them, unless you're locking into a CD, a certificate of deposit, those high-yield savings accounts that are liquid have variable interest rates. So they're going to change over time. If rates go up, then generally speaking, they will follow suit. And if rates go down like they have started to, generally speaking, they will also follow suit in the opposite direction. And so I think what they're talking about is, hey, why would you just necessarily stay in this high-yield savings account knowing that the interest rate is going to continue to drop as the Federal Reserve lowers rates, when you could potentially rotate into something else like bonds or fixed income where you could pick up a little bit of a return. And I think that's what they're talking about. So specifically with that, and I'm not saying to do this or not do this. As everybody knows, we don't give any advice on the show, right? We're just talking. I'm just a dude on a microphone, right? Real talk, personal finance, education, entertainment, do your own due diligence, consult your own professionals, right? I might be a professional, but I'm not your professional. Now, with that said, what they're talking about or likely referring to are these shorter term or shorter duration types of funds. And so what happens is, going off of the last example I gave, but now we're going to do it in the opposite direction. If you had holdings in these other short-term or shorter duration funds, okay, especially the ultra-short ones is I think what a lot of them are going for, then what's going to happen is as rates come down, so if you're buying into that now, and some would even argue it's quote-unquote too late. Again, not a recommendation to do it, not to do it. I don't give a fuck what you do. Personally, I'm not doing this, but people have and people will, and that's totally fine. But you could potentially get into some of these funds at a particular price point, right? And these funds own these bonds that are paying certain coupons. And as rates continue to come down, what do you think happens? And that's where the magic is. When rates continue to come down, these existing bonds at these current rates, which in the future will be likely these higher rates when interest rates keep dropping, become more valuable. So not only did you lock in potentially a coupon from these types of bond funds that are going to pay a particular yield that's a little bit higher. But when rates continue to fall, you may also experience and benefit from capital appreciation or growth based on the price of what that fund is worth, because those bonds are now worth more. And I think that's what they're talking about. Again, depends on the types of bonds that you're buying. There's generally always, some would argue that there's some risk-free if you're looking at government bonds and things like that. But usually there's always going to be some element of risk that comes with it. It also adds a little bit of complexity. It also adds a little bit of cost from an expense ratio standpoint, depending on what you're looking at there. And yes, some of these are very, very nominal amounts and negligible expense ratios, but there still is going to be a cost to being in some sort of a fund like this. There's going to be the cost of the time to, make all this happen. But in the case of some people, maybe it's worth it for them to do that. Then the question becomes, all right, well, what happens longer term in the future, right? Maybe they choose to get in now. When do they choose to get out? Because what happens if rates were to come back up again in the future? Just like we talked about earlier, it's quite possible that the value of those bonds could then turn around and decline. And everybody likes to think they're going to be smart enough to know when to pull the trigger in one direction or the other, but we've all seen and we all know that over time that doesn't necessarily always happen. Right? So do whatever you like, do it at your own risk. But I think that's what this person is referring to or talking about, where people are rotating into certain types of bonds. So again, something to look into if it's of interest to you, but it sounds to me like what they're talking about. Okay, so let's see, what else do I have on my agenda here? We talked about individual bonds versus bond funds. We gave the example. We talked about some client examples and portfolios. And so let's get into, different types of bonds, right? So as I mentioned before, there are going to be government bonds, right? Many people have heard of, treasuries, for example. So there's government bonds that are out there. There's also going to be corporate bonds that are out there. And there's going to be different types of corporate bonds. So you might hear about things like investment grade bonds, which are typically issued by corporations with very high credit ratings, right? There's different rating agencies out there, and there's been a lot of conversation and even movies that have been done about how they're all fucking crooked and the rating agencies can be, manipulated, and we'll save that for another day. But the point is that in theory, these investment grade bonds are of higher quality, and therefore, generally speaking, the yields on those, because they're coming from higher quality corporations, could be lower. Right? Within that same corporate bond category, though, you may have also heard about high yield bonds. Sometimes they're also called junk bonds. Those are typically issued by companies where their credit ratings aren't quite as good. However, the rates that they are offering are a lot of times quite a bit more attractive than your investment grade bonds, right? So there's a whole bunch of different types of bonds out there. Like I said, you can look into them and see which are going to be of interest to you or not into you. Or to you. Government bonds, you can go to a website like treasurydirect.gov is a really good resource. Back when inflation was very high, I think we actually did do a podcast, at least one podcast, possibly multiple, on, I think it was Series I bonds, where the coupon or a part of it was linked to, there was the fixed rate component, and then they had a portion that was linked to inflation. And so that had the ability to change periodically depending on what inflation was doing. If inflation was high, which it was, I believe I'd have to go back and look at it, but there was a time period where these I bonds were paying somewhere between like 7 and 9%, which is, really good, especially when rates were really low and inflation was really high. And then all of a sudden rates shot up a little bit, and these bonds didn't, they weren't quite as attractive, because sometimes they do take a little bit of time to reset these rates, and all of a sudden you had other fixed income or deposit product vehicles that were moving upwards faster, and you saw a lot of people rotating from things like Series I bonds into, for example, high yield savings accounts or CDs or whatever the case might be. So anyway, if you're interested in government bonds, check out treasurydirect.gov. There's other ways to buy them. If you work with a financial advisor through different institutions or an online brokerage, you can look at some things that way. But if you're looking at government bonds, sometimes it's a pain in the ass because their website sucks, quite frankly. But sometimes the best way to look into something like that would be through like treasurydirect.gov. Let's see. We talked a little bit about retirement accounts. So in retirement accounts, for those that are using fixed income, generally speaking, they're going to be bond funds. And there's going to be different types of bond funds out there. So for example, in a retirement account, one type of bond that you're not going to see, or bond fund that you're typically not going to see, is what's called a municipal bond fund. Whereas if you're looking at like a taxable account, for example, so you have, basically an account that's a non-retirement account, and now all of a sudden taxes and taxation becomes more important to you. Okay. Well, in that instance, you may want to look into municipal bonds, specifically if your tax rate is on the higher end. Generally speaking, the higher your tax rate is, the more beneficial municipal bonds could be to you, assuming they have a place in your portfolio, assuming we're talking about a non-retirement account, right? Sometimes people call them munis, and they generally come in two flavors. You have GO or general obligation bonds, right, which is basically backed by the issuer's credit, essentially, like most bonds. And then there's also revenue bonds, which are backed by certain sources, like, for example, like toll roads or bridges or whatever, that those bonds and their income streams and whatnot are backed by the specific revenue that's generated from those activities. So you have that, and so it's going to vary depending on the type of account that you're looking at. Now, one thing, so let me back up for a second. If we're talking about what I think this initial email was, which is like, hey, if high yield savings rates are going down, where do I look? You might be looking at certain types of short duration bond funds for the reasons that I mentioned before, right? So that's one thing. If you're talking about just a retirement account and you're just trying to add stability and some income production to your portfolio, maybe you're looking at other types of bond funds that exist out there. If you're in a non-retirement account and you're in a very high tax bracket and you want and have decided that fixed income needs to be in your portfolio, instead of just buying a normal bond fund, like just a regular, say, corporate bond fund, for example, in your taxable brokerage account, maybe you would look at something like municipal bonds. And that has to do with the taxation, because I don't know if we touched on this before or not, but if you look at interest income that's generated from bonds or bond funds, it's taxed at ordinary income. Well, if you have money, say, in a traditional IRA, for example, that's all pre-tax money, or a 401k that's pre-tax money, when that money comes out, it's coming out as ordinary income anyway. So you don't really give a shit. You don't need to do anything fancy. The taxation really doesn't change. However, if you have a taxable brokerage account or non-retirement account and you're utilizing bonds, for example, well, why would you want to take an asset that you have to pay ordinary income taxes on in that account if you can have an asset where you could potentially exclude some, if not all, of the interest from taxation, right? So municipal bonds generally are going to be exempt at the federal level, but then depending on the state that those bonds are issued and the state that you're in, it potentially could also be exempt at the state level. Again, if that's of interest to you, go ahead and go down the rabbit hole and check out municipal bonds, and you'll find a ton of information. We don't have time to go into all the itty-bitty details of every little thing on today's show. This is kind of just meant to be a general overview and just give you guys some nuggets, again, to kind of use as a springboard to go off and do that additional research if you decide to do so. One other thing I want to mention is this white paper that I alluded to earlier. And this is going to be specifically not what the listener was writing in about as a cash equivalent necessarily, right? Not as an alternate place to park cash, although it could be specifically for older clients. But when you're looking at retirement accounts and retirement portfolios, I've seen articles like this that have come out several different times. This one's actually from June of 2024. This is a white paper from Allianz Bernstein, and the title of it is The Fixed Indexed Annuity, a New Core for Retirement Saving, ? And on the front of it, it says, with a challenging market expected ahead, the classic 60-40 stock bond strategy may struggle to build wealth and fund retirement spending for investors. Allocating some traditional core bond exposure to a fixed index annuity could change the game. And we'll talk about this in a little bit, but I just want to be clear and set the stage that annuities are generally going to be long-term in nature. They're generally going to be for clients that are at or approaching retirement or a little bit older. This is not necessarily something that, it's not something at all that a 20, 30, 40-something-year-old is going to want to take some money they got chilling in the bank and plow into one of these things, because when you take money out of these before 59 and a half, generally speaking, you're going to be subject to 10% early withdrawal penalty. So I'm talking more so for like the person approaching retirement that maybe has a moderate portfolio, that maybe was subscribed to the whole 60-40 kind of mantra. Is there a way for them to potentially tweak what they're doing and get better results by adding things like a fixed index annuity, which, by the way, we did do a mini series on annuities before. So if you look up, we've done fixed annuities, index annuities, or fixed index annuities, same thing. We've done variable annuities. We've done several different shows on that. So you can go back in the archives if you want more specifics on annuities and kind of what they are and how, or why they might make sense. But I'm just going to go through a couple of bullet points on this article and some things that I highlighted on this white paper, because I think that a lot of people that are approaching retirement, this might be something to sort of rethink. And personally, as an advisor, and professionally as an advisor, I love annuities, not only because the commissions are good, but also because they really can help a client in their overall retirement readiness and situation, specifically when it comes to lifetime income and things along those lines. So let's get into it here. So from the executive summary, I'm not going to read this entire thing, but I just highlighted a few points here. The fixed index annuity, for example, has a structure that, substituted for part of a traditional core bond allocation, helped retirement savers accumulate more assets in 73% of our scenarios. And so they just kind of go through some of that. Let's see what else I got here that I highlighted. We have... these solutions include using the fixed index annuity to augment a traditional core bond allocation. They go into some information about using this with and without an income rider. So again, when you're looking at lifetime income in retirement, a lot of these annuities have little bells and whistles, call them riders, that can be added on to certain contracts that can create a pension-like check or a lifetime retirement income stream that can be really good for folks. Because again, if you go back to the beginning of the show, the role of bonds for most people is stability and income production. Well, if you want stability in income production, that's great. Maybe you do look at bonds, or maybe you do have bonds for a portion of your portfolio. But again, as we've talked about through today's episode, that has the ability to change. Bonds can decline in value. Interest rates can and will change over time. So if you want something that has a little bit more certainty based on the way that it's structured, and it has more sort of guarantees in place, this could be something that you might want to explore for a portion of your portfolio. Another point in this white paper says, over a 10-year accumulation period, the fixed indexed annuity enhanced portfolio, so when people added this in as a portion of their core bond allocation as opposed to not having it, built more wealth than the 60-40 did in 73% of the simulations. For a $1 million portfolio evaluated across 5,000 simulations, the average advantage worked out to equal $65,781 over 10 years. All right, let's see. What else we got here? And then they talk about using income riders versus not using one. You can have about a 12.5% lift in your expected income amount if you just had a traditional allocation versus if you had one that you enhanced with a fixed indexed annuity. So I'm not trying to make this a commercial for fixed index annuities. There's a million of them out there. There's some good ones. There's some bad ones. They all have their use cases. Again, I won't bore you with all the details on that, but just know that if you're thinking about bonds, if you're using bonds in the context of a retirement plan or retirement account, and you're approaching retirement, especially if you're not going to have a traditional defined benefit pension plan, like a lot of retirees unfortunately will not have, then this might be something you want to look at incorporating into your strategy. And, just really quick, the way that most of these fixed index annuities work, and there's all sorts of variations, but virtually all of them are going to be principal protected with the potential for growth, and with these additional optional riders for an additional fee can provide lifetime retirement income under certain conditions and different parameters. And we'll save all that. You go back and listen to the annuity shows if that's of interest to you, or write in with questions if you have them. But that's basically how that's going to work. So as far as it goes today for bonds, again, that's where a lot of us believe that money goes to die. So I'm not a huge fan, but that's fine. It's not about me. It's about, trying to disseminate some information for all of you. Most people are going to use them for stability and income production. There is an inverse relationship between interest rates and bond prices. So when one goes up, the other typically goes down, and vice versa. We talked briefly about individual bonds and holding them until maturity versus a bond fund that don't have a definitive set maturity date when you have multiple bonds in the portfolio. We gave some examples of interest rates changing over time, talked about some clients that experienced some losses or some unrealized losses, assuming they didn't sell in the fixed income part of their portfolio when rates went up, and why and how that works. Different types of bonds out there, for example, government and corporates. We talked about munis really quick, retirement versus non-retirement, touched on this article here. And I'm doing everything I can to just make this as quick as possible because, again, I think if I went too long with every little itty bitty thing, we got into zero coupon bonds and we got into all this other shit, that we would just lose people. So hopefully that's helpful. Hopefully that gave you something to go off of and you can do a little bit more research and figure out whether or not this is going to make sense for you and then proceed accordingly. But hopefully that's a little more than you're getting on your, I think it was it TikTok or Instagram? Yeah, definitely a little bit more information than you're going to get on your Instagram reel. But hopefully this was somewhat helpful. If you have additional questions, feel free to reach out to the show. Hope you guys enjoyed it. Consider becoming premium. And we will see you in the next episode with the winner of the $25 e-gift card giveaway.
Woo! Check the mic and make sure it sound right, boys.